Mutual fund investments are subject to market risk. Please read the offer document carefully before investing.
Most of us wouldn't have understood what we just heard, but understanding mutual funds are a lot easier. A mutual fund is a common pool of funds, invested by different investors. The fund manager then invests these collected funds amount into specific securities, like bonds, shares, or other money market instruments. The returns earned through these investments are shared by its investors, in ratio to the number of units owned by them on pro rata basis. The U.S. Security Exchange Commission defines a mutual fund as, a mutual fund is a company that pools money taken from many investors, and invests the money in stocks, bonds, short-term money market instruments, or other securities. Let's suppose you wish to open a pizza store by pooling in money from 20 friends. 18 of your friends agree to your proposal. But 2 friends say they would lend you money, but are not willing to take risk by investing. So now you have $180 contributed as investment, and $20 as liability. A pizza is made up of ingredients like flour, cheese and vegetables. The price of the pizza is determined by the price value of each of these ingredients. If we wish to divide this pizza into say 4 slices or units, then the value of each unit is calculated by value of the full pizza divided by number of units. A mutual fund works in a similar way. Just like flour and cheese constitute a pizza, the mutual funds are constituted by stocks and bonds. A mutual fund can be broken up into various units. The value of each unit is called the NAV, that is net asset value. NAV is equal to value of all securities minus liabilities divided by number of outstanding units in market. So now the NAV of your pizza would be $200 minus $20 divided by 18, which would be equal to $10. Remember, we had borrowed $20, these are liabilities. Liabilities are loaned or borrowings which needs to be paid off before distributing the income to mutual fund investors. The proportions of each ingredient of the pizza would affect the price. Some pizzas may have extra cheese, hence, change in price of cheese would have an effect on the overall pizza cost. Similar way, NAV will be affected by the instruments that it is invested in. In mutual funds, investors buy shares from either the fund itself or through a fund broker. Unlike in stocks where shares are purchased from the stock markets, fund's unit price is actually its net asset value and other additional fees that the fund company may impose. For a stock, it is the market price at which it is currently traded, is taken into account for purchase. Mutual funds can be redeemed, in the sense that investors can always sell their units back to the fund or broker. In stocks, the purchase and sale of stock happens in the stock market, wherein the seller of a stock has to find a prospective buyer and vice versa. In a mutual fund investment, the investor's time and effort are saved because the investment decisions are taken by the fund manager. Distinct entities called investment advisors manage the investment portfolio of all funds. These advisors have to be registered with the regulatory agency. On the other hand, stock trading is done by the individual himself or with the help of a brokerage agency. Mutual fund is a collection of many asset types like stocks, bonds and money market instruments. As a result, diversification is very high. In stocks, the investment is mainly restricted to one form of asset type, and hence diversification is low. Stocks give focus investment. When there is an increase in the value, the returns are higher and vice versa. Stockholder is a part owner of the company who can influence the decision taken related to business ventures, but mutual funds are investment opportunities which do not provide the holder any such advantage.